Welcome to The Explainer. Today we are talking all about business budgeting, and we're going to take this thing that a lot of people find kind of scary, this big formal document, and show you what it really is, your company's actual roadmap to success.
So let's just jump right in with a question that, honestly, it keeps a lot of entrepreneurs up at night. Why do so many businesses that seem so promising just fail, and so quickly? And look, it's probably not for the reasons you're thinking. The answer is usually way, way simpler. And yeah, it's all about the money.
And there you have it, the number one reason. You know, it's not a bad product, it's not a lack of passion, it's just plain and simple, they run out of cash. And this fact right here, this is exactly why what we're talking about today is so incredibly important. Not just for growth, but for basic survival.
So what's the tool that keeps this from happening? A budget. But listen, this is way more than just some boring accounting exercise. You got to think of it as a strategic plan for your money. It's a way to get your team fired up with clear goals, and it's a system to actually control your own financial destiny.
Okay, and this is a really important distinction to make. You've got financial accounting, which is all about looking backward, right? Recording what's already happened. But budgeting, that lives over in management accounting, which is all about looking forward. It's about using financial info to make smarter decisions that actually shape your company's future. So let's get into step one, and you'll see how this all builds on itself. Before you can even think about creating a budget, you have got to know your costs. I mean, it's non-negotiable. It's just like planning a road trip. You can't get very far if you don't know how much the fuel is going to cost.
So to make this super clear, let's use a simple example. Let's imagine a company called Case Creations that makes custom phone cases. Now their costs basically act in two different ways. First, you have fixed costs. Think of their factory rent. It's the same every single month, no matter if they make one case or a million. Then you have variable costs, like the plastic for each case. That cost goes up with every single unit you make.
All right, but there's another way we can slice and dice these costs. We've got direct costs. These are the easy ones. You can trace them right to a single phone case, like the plastic it's made of, or the wages for the worker who put it together. Then you have indirect costs, sometimes called overheads. These are just as vital, like the factory's electricity bill or the supervisor's salary, but you can't really pin them down to just one single case.
Okay, so knowing that difference lets us calculate a really important number. It's called contribution. All you do is take your sales price and subtract all the variable costs that went into making that one product. What's left over is your contribution. And that's the money from every sale that helps pay for your fixed costs like the rent. And then, the best part, anything left after that is pure profit.
So now that we have a good handle on our costs, we can actually start building the budgets. And a good way to think about this is that each type of budget is like a different lens, and each one gives you a totally unique and totally essential view of your company's future. Now, most budgets are built in a really logical sequence. It's like a set of dominoes, right? You knock one over, and it sets off the next. And it almost always starts with the sales budget. This is your best guess at how many units you're going to sell. From there, that tells you what your production budget needs to be, which then tells you what your raw materials budget has to be. See? One thing leads to the next.
But of all of these budgets, there is one that is, without a doubt, the king, and that is the cash budget. We are not talking about profit on paper here. We're talking about the actual real-life cash moving into and out of your bank account. It is the absolute lifeblood of the business because, let's be honest, without cash, nothing else matters.
So why is it so important? Well, because this simple forecast is an unbelievably powerful early warning system. It literally tells you if you're going to have enough money to pay your bills next month. It spots cash shortages way ahead of time so you can arrange for a loan. And on the flip side, it also shows you when you'll have extra cash that you can invest. It's a game changer.
So all these little budgets we've talked about, sales, production, cash, they don't just float around on their own. They all roll up together into one big, comprehensive document that paints the entire financial picture of the company. And that's what we call the master budget.
All right, let's move on because this next part tackles a huge challenge. I mean, a plan is pretty much useless if you can't adapt when reality, as it always does, decides to throw you a massive curveball.
So let's go back to Case Creations for a second. Imagine your original plan, your static budget, was built on the idea of selling 10,000 phone cases. But hey, good news, you actually end up selling 12,000 now what? Of course your variable costs are going to be higher, but is that a good thing or a bad thing? How can you even tell?
And that is where this amazing tool called the flexible budget comes into play. See, instead of being stuck with one single prediction, a flexible budget basically says,
Okay, you sold 12,000 units? Let me recalculate what your costs should have been for that level of activity. This lets you make a fair apples-to-apples comparison.
So what a flexible budget does is show you what your costs were supposed to be for the number of units you actually made. So if you look here, if Case Creations actually produced 15,000 cases, you can now compare your real-world costs to the 565,000 you budgeted for that specific level. Now finally, the comparison actually means something.
In that comparison, that's everything. It lets managers see exactly where they came in over or under budget for that real level of activity. These differences, accountants call them variances. They're basically clues. They're the first step to figuring out what went right, what went wrong, and most importantly, how to fix it.
Right, so once you spot a variance, the next question is, who's responsible? And this is all about accountability. The key here, and this is about fairness, is to only focus on the costs a specific manager can actually control, like how much material the purchasing manager bought. You have to separate those from the costs they have zero influence over, like if the landlord decided to raise the rent on the whole company.
All right, let's bring this all home. After all that, why does any of this stuff actually matter? What are the big things you should walk away with?
Look, at the end of the day, budgeting is not about putting your business in a straitjacket. It's a complete system. It gives you a plan, it motivates your team, it clarifies who's responsible for what, it makes you more efficient, and, maybe most importantly, it's that early warning system that spots trouble and gives you time to actually do something about it.
I absolutely love this quote from Dave Ramsey because it just nails it. A budget completely flips the script. It takes you from being reactive, looking at your bank statement at the end of the month and wondering where all the money went, to being proactive. You are in the driver's seat, telling your money exactly where it needs to go. Let's finish up with one last really strategic idea. Every single business has a bottleneck. There's always one single factor that's holding it back from unlimited growth. This is called the principal budget factor. For a lot of companies, it's just sales demand. But for others, it could be that they can't produce things fast enough, or they can't find enough skilled workers.
And we are going to end with this thought right here. The real magic of strategic budgeting isn't just about counting the pennies. It's about identifying that one single thing that's holding you back and then focusing your entire financial plan, all your resources, on breaking through that barrier. That is how you unlock your company's true potential.